Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is June 5th of 2023. We're certainly glad that everyone could join us. We hope that everyone had a great weekend. We took a week off for the long weekend in honor of Memorial Day, but we're back at it this week. And what we really want to focus on this week is the historic bubble that is taking place at the very top of the stock market, because how we manage bubbles and how we have the discipline to not chase sort of this dream and concept of artificial intelligence or whatever that Wall Street fashion show is for the latest bubble. How we navigate that is going to really determine whether we're able to generate a ton of positive performance, or on the other end, go into a second deep drawdown. And so we want to make sure we're following our process. We want to make sure we're getting the big picture correct. And just as important, we want to make sure we're avoiding those asteroids. And so that's really the title of this week's presentation, is how do we avoid the next asteroid? And the three big things that we're going to focus on this week is, again, that historic bubble that's forming at the very top of the NASDAQ and the very top of the S&P 500. Number two, what do we think that weak stock market breadth means for stocks and overall asset allocation? And number three, if and when that artificial intelligence bubble pops, and we do believe it's going to pop and it's going to be a bloodbath when it happens, where do we believe that money is going to flow toward? Because that's going to be the second key to this trade. Now, when we think of the 2020s, the most important chart for this decade, we believe, when people look back at the market in 2030, it's going to be this chart right here, right now. Commodities to equity ratio. So when we look at whenever it has been at extremes, whether it's at a high-end extreme or a low-end extreme, it has certainly been sensible to either reduce commodities exposures when we're getting these extreme outliers, or to start to pick up sizable commodity exposures when that risk to return, or that return to risk ratio, is very attractive. So right now, when we look at where commodities are relative to equities, when we look at the valuations, energy, the cheapest sector in the S&P 500, precious metals, historically cheap, just as the US dollar is beginning to top out, we think this is the trade of the decade. This is very similar when we look at back in 2009 and 2010. This reminds us a lot of those relative strength charts that were breaking out in favor of technology, and in particular the Apples and the Googles of the world at the time, and that really defined that technology boom for the next decade. This is the chart right here, right now. And this is what we're going to stay focused on. And we really encourage clients that if they believe in the thesis, they like the setup, then to stick with it, right? To stick and say, you know what, this is the strategy for that. We have other strategies where we can incorporate technology, we can incorporate other areas of the market, but for that core strategy there, this is where we're positioning the portfolios. And as we always said, bubbles are fun until ... until they collapse, is basically the point here. And so this is the chart on the right here, is the NASDAQ 100 relative to small caps, right? So when we look at the last time we were at this extreme point, was right at the very peak of the technology.com bubble in 2000. The same thing has happened today. History doesn't always repeat itself, but it does often rhyme in very symmetrical patterns, right? And then when we look at Avago last week, Avago was a great example, as our friends at Strategas point out, of a stock that had a blow off top, and the value traded went through the roof. This is what we call this euphoric high, this euphoric and frenzy to buy the stock at any price in disregard of any valuation. And it's important that we're paying attention to this stuff, because the impact of bubbles is they suck money out from other sectors, but when they collapse, that money goes flowing back into the other parts of the market that are well set up. So the other big comparison that we've been using is Cisco versus NVIDIA. And every day this week, we've been getting calls from people, NVIDIA. And anecdotally, when you start to get that, it's very emblematic of this sugar high bubble that is in its most intense phase of euphoria. And NVIDIA is a great company, and so is Cisco, right? And so if you bought Cisco, so Cisco's the red line here on the chart on the right. You bought Cisco at the very peak in 2000, you got the story correct. They were the winners of the internet equipment space. They did, in fact, provide all the plumbing for the internet in North America, all the plumbing for the internet in China and in Europe and in across Southeast Asia and the emerging world. They were the winners, but their stock was a loser. Why? Because in the midst of the dot-com bubble high, everyone was pricing that in. Same thing with Microsoft in 2000. Microsoft went on to post losing returns for the next 10 years. Why? Because everyone already knew they were going to win the PC race. Everyone already knew they were going to dominate the operating system space within PCs. Everyone knew it. So you needed additional news or some other factor to justify the stock at such a high level. And that's very similar to what we see in NVIDIA right now. So NVIDIA, pardon me, Cisco is the blue line. NVIDIA is the red line. And it's a very similar pattern. I don't like overlay charts that much because you can always get something to fit if you try hard enough. But in this case, the correlation is hard to ignore. And so when we look at NVIDIA, very same story, $1 trillion market cap for a company that is expected to generate 50 billion in revenues in 2025. So you're essentially paying right now 20 times sales, not for this year, not for next year, but for 2025. And what we are most likely suspecting here is that companies right now are double and triple ordering GPU chips for applications they may or may not develop. And so what ultimately is going to happen, in our opinion, you're going to get this inventory overhang where companies, yes, they are moving forward with AI, but, and a big but, maybe they don't need all those chips that they order. And so this is going to be a big story. Again, NVIDIA, great company. I think it's going to be the winner in terms of AI and the chip space and the chip race. But that doesn't mean it's going to be a great stock. And that's really what we got to be careful with here. The euphoric rush into NVIDIA has been one for the history books, and one that we're certainly, now, do we wish we bought it 100% ago? Sure. But if we had owned it, we'd be selling it right now. And certainly this is not an area that we're going to try and pick up pennies in front of that bulldozer. When the chart on the left here, look at the NASDAQ 100 relative to the Russell 2000. Again, the same thing, the 3-month rate of change of the NASDAQ versus the Russell 2000, which are small caps, are, again, at the 99th percentile of historic observations. When is the other times that have happened? Right here, 2020, that was a peak for NASDAQ relative to the Russell. And again, of course, that 98 through 99 time period right before that historic 70% plus NASDAQ collapse. So again, we want to be very, very careful. And when we talked about how this bubble is sucking money out of every other sector in the market, these charts say everything you need to know. This is the relative performance, high and lows of the S&P industry groups. So of all the different industry groups in the S&P 500, what are the sectors that are making 3-month relative highs, and what are the sectors that are making 3-month relative lows? Remember, the S&P is up 9, right? So relative highs, computers, broadline, retail, IT services, and semiconductors. That's it. Meanwhile, 3-month relative lows, biotech, food, oil and gas, air freight, auto, chemicals, machinery, media, metals and mining. Like, you can go with every part of the market's making 3-month relative lows, but you have this tiny little sliver that's in bubble territory. And you can see that in the May 2023 performance. Stocks, the semiconductor index, up 15%, tech up 6%, QQQs up 8%. Meanwhile, everything else deeply red. So this is not the sign of a market that's healthy. It's a sign of a market that's super narrow and where risk is really represented at the very top of the market. And we can see that here in this chart. The S&P, what I call the S&P 493. So the S&P 500 minus Microsoft, Amazon, Apple, Google, Tesla, NVIDIA, right? So those 7 stocks are up 44% year to date. Take those out of the S&P 500, which is up 9, not including this earlier this week. S&P 500 is flat. You look at the S&P 500 equal weight, again, same story. The percentage of stocks beating the S&P 500 near historic lows. The only other comparable time period you can see here, right here, is the 2000 bubble peak. So again, we have to be really careful. Why does breadth matter so much? Because the only two other times we've seen breadth this week was in the 1990 example and the 1999 example. Both times, both of these narrow parts of the market, these narrow markets preceded a collapse of the very top of the market, right? While meanwhile, the other areas of the market started to recover and bottom, right? So that's a very key concept of what we want to discuss next. If the top of the market starts to collapse, where is all that money going to go? Where's all that bubble money that's been piling into those 7 stocks? Where's it going to go? And we think where there is darkness in that technology bubble, we want to look to the light, right? We want to see what is the next chapter in this great stock market history that's been around for 100 years and plus. And where we think that money is going to go is into energy, into precious metals, into industrials, in those old economy areas of the market. When we look at the S&P energy relative to technology chart, we see here, it is again at a 99th percentile extreme. So as tech peaks out, and if assuming we're correct on that, we likely see a mean reversion to energy. In other words, energy goes up, tech comes down. And we can see that again with energy sector ETF flows, again, at a -2 standard deviation. So everything is lining up, this huge mean reversion trade where you get everyone suddenly piling out of tech and into energy and into precious metals and into gold. And that's where we want to be, right? So the bottom line is, as the tide of history starts to turn away from speculative tech, remember, over the weekend or during the week, I want you to think anecdotally, how many people out there are talking about NVIDIA and AI and all this stuff? Because if everyone's talking about it, that's not where you're going to make money, right? There's a reason why the top 1% are the top 1%, because they're doing something very different than the 99%. And that's what we're trying to focus on. We did it in early 2021. We kind of got away from that a little bit, and we're going to be disciplined, and that's what we want to do. That's the turn. We nail the turn, we nail the returns, we nail the story. That's the whole concept there of trying to time those market shifts. So yes, we believe that technology AI stocks are in the midst of this euphoric phase. The market is historically narrow with most stocks down in 2023. And the result is we think gold and energy may be the next chapter of stock market history in terms of providing that next chapter of secular leadership. So that's what we got this week. 888-543-3776. If you have any questions, please feel free to reach out to your advisor. Otherwise, have an absolutely fantastic, fun, and healthy week. Talk to you soon.